What is going on, my people? If you don't know who I am, my name is Clarissa and I'm Javier's partner both in life and in business. Together, we've helped over 400 credit and funding companies scale by implementing the same systems that helped us scale our company to over seven figures. And today, I want to break down exactly how to structure your client's credit profile for maximum business funding. This is the foundation that everything else we will build on. Here's the reality. Most funding companies focus on business credit, but what they're missing is the most important piece. Even though you're applying for business funding, the approval are still based on your personal credit, especially for the first few years of business. And I'm about to show you the exact personal credit structure that gets clients approved for 100 to $200,000, even 250K in business funding. And this is the same exact blueprint that we've used for all our high limit approvals. So if you're tired of getting your clients denied or approved for pocket change when they could have been getting six figures, pay attention because this is going to change everything for your funding business. Before we dive into the structure, let me explain why the personal credit is so critical for business funding. So for the first 2 to 3 years of your business, decisions are based off of your personal credit. The banks are going to use your personal credit as their primary risk assessment tool. Business credit reports don't have enough data for new companies, so the personal guarantees ties to the business personal debt and credit worthiness. So what banks are looking for? What banks actually look at are the personal FICO scores, not just your business scores, personal credit utilization, personal payment history, personal credit mix and age, personal debt to income ratio. And this is exactly why we can have clients with the perfect business setup, but terrible personal credit, and they will still get denied anywhere. Or maybe you can also have someone with a brand new LLC, but personal credit, and they will get approved for over 100,000. Now let me show you exactly the structure that we use to get our clients approved for maximum funding. So the minimum acceptable FICO score that you can have in order to go through a funding round would be a 680 FICO score. Something good is between a 720 and a 745, and for optimal, you want above a 750 FICO score. This is for best approvals. But here's what most people don't understand. It's not just about the credit score because banks will look also at different type of FICO versions. We have the FICO 8, which is the most common, the FICO 9, which is a newer version, and then we have an industry specific FICO scores. So your clients need to be strong across every single one of these versions, not just one. Next, this is where most people actually mess up, right? Because you need to have a complete structure, right? We need to have utilization to be under 10% and never above 30%. A sweet spot is around 7% of overall utilization to have the highest FICO score. You don't want it to be completely at zero because you're showing the banks that you don't use the credit cards. And let's be realistic, they make the money after the 0% period ends. They make money if you hold a balance on the credit cards, so they want to see that you hold some type of balance, so that they can, therefore make their money afterwards. So if you're always at zero, is not that good, right? We want to always leave a little bit of balance just to show the banks that we're actually using these credit cards, right? And this utilization needs to be per credit card. So each credit card individually needs to be in the 7 to 10% range, never ever above the 30%. And then you want to have some credit cards with zero balances, so like two or three cards with zero balances. And then you need to have at least one credit card with a five to $10,000 limit. Like ideally we wanted to have more than 10,000, but if not possible, then we would want it to be at least a $5,000 limit. Next, your client needs to have a mix of accounts inside of their credit profile. So you would want to have at least a 3 to 5 revolving accounts, and this needs to be individual accounts, not authorized users. Authorized users can help, but they're not a once and for all. Like that's not the only thing that they can have. So 3 to 5 personal credit cards at minimum. They need to have a mix of different products. So They should have some installment loans, so one or two accounts, whether it is an auto loan, a personal loan, or a mortgage. And then they should also have an average credit age of 2 plus year, where the oldest account is preferably at least 5 years old. The sweet spot is to have 7 to 10 total accounts with a good mix of revolving and installment credits inside of their credit profile. Now, when we structure our clients' credit, we use a system for it. So you should have always a tier system, right? So the first tier is going to be to have this must have banks. So your clients should have at least one product with at least one of this bank per each of these tiers. Tier one are going to be the must have: the Chase, the Amex, the Bank of America, and the Wells Fargo, with at least one of them to be with a limit of the $5,000 to $10,000 plus. The second tier is going to be the good to have banks. This one are going to be the Capital One, the Discover, the Citi, and the US Bank. This one will add some depth to their credit profile. And then the number three, tier three, is going to be the ones that you should be avoiding, which is going to be the Credit One, the First Premier, and the all store cards. So all the Target, the like Macy's, and all of those credit cards. This one will actually hurt your high limit funding chances, because it looks like you're applying only for products that are not that many beneficial. So 80% of your products should be between tier 1 and tier 2 in order to get maximum funding approvals. Now, here is how we structure the client's personal profile in order to get maximum funding potential. So first things first, we would want our client to have at least $50,000 in personal credit limits. And here's why. This will show banks that they can handle large amounts. It will demonstrate credit worthiness to the underwriters. Then we would want to also have at least one card with that $5,000 to $10,000 limits. If it's 15K plus, it's even better. And then we would want to have at least 2 to 3 cards in between the tier 1 and tier 2 that we previously talked about. And we try not to have any credit cards that are under $2,000. We would try to request a credit line increase if they have any of them, if this doesn't incur an increase for it, because this will actually, it can hurt the outcome of the funding. Next is the payment history, and this is a non-negotiable for maximum funding. Zero late payments, so no late payments in the last 24 months at minimum. Zero charge-offs, so no collections, no bankruptcies, anything like that. No settlements in accounts on the reports, and 100% on-time payment across every single account. So you will have a 7-year rule. So negative items older than 7 years old, they don't really matter. But anything recent, it can kill your funding chances. I know this may seem like a lot to manage for each client, and honestly, it probably is. Most funding companies don't even have the system to properly analyze and optimize their clients' credit profiles, which is why they get inconsistent results. That's exactly why I created the Funders Academy, where I teach funding companies owners how to scale their businesses for just $99 a month. Inside, we have a complete credit system analysis tool, complete optimization strategies, and a step-by-step process to get your client's credit reports funding ready. And if you want the complete business infrastructure, including our credit analysis softwares, client management systems, and personal help implementing everything, you can book a call to join our inner circle instead. But now let me continue with the advanced strategies that separate the $50,000 approval to the $250,000 approval. Now, for clients with thin credit profiles, what you can do is that you can add some authorized users in their credit profiles. You should add some authorized user that have a high limit and a high age in their accounts. You have to choose accounts with, of course, perfect payment history, and you should avoid accounts with high utilization. This can boost their FICO score by 50 to 100 points in less than 30 days, in 30 to 60 days, depending on the reporting date. Now, you want to also make sure that there's not too many authorized accounts, I would stick to one, maximum two. You can either purchase them, so have the client pay for them, or maybe they have access to some of them through their family members and they can just add them without having to pay. Now, remember, the authorized user, I always call it like makeup, right? You can add some so that it can look prettier, but if you're ugly, you're ugly, right? Like you can't do magic with it. So they're going to be something that can enhance their credit profile, but it's not going to be the only, like you can't just have that. They need to have a solid base on their own, and those are just going to be adding up to it. Now, another thing that you can do is for the clients who don't have a lot of credit mix, and that is going to be to adding like adding a small personal loan, so a $5 to $10,000 loan, or maybe an auto loan if they also need a vehicle. You can look also into credit builder loans from credit unions, and this works because the clients like to see that their clients are going to be able to handle different types of debt. Next, it would be the inquiry management. So you need to space out the credit application if you're going to do any on the personal side within a 90 days apart. So you're going to be applying for cards that pull from different bureaus and avoid increase sensitive banks when clients have recent pulls. So you shouldn't have more than 2 to 3 increase per bureau in the last 6 months for maximum funding. Next, you want to make some industry specific considerations, right? Because different industry will require different credit structures. So if you have a client that is in the higher risk industry, like credit repair, real estate, even people who do funding, that's ironically, that's a higher risk industry, you will have to have a 700 plus credit score, a more established credit history, and larger limits than everybody else. Someone who is in a lower industry can work with a 680 FICO score, and it could have a little less requirements compared to everybody else, and it could also have faster approval processes. These are, for example, consulting, e-commerce, and professional services. And then you want to make sure you're being aware of regulated industries, because those are going to need perfect time. Payment history is going to be critical for them. They absolutely going to need a longer credit history, and it can also require some extra documentation, like proof of it on both on the personal side and on the business side. So these are, for example, financial services or healthcare businesses. Now, here is how you can get your client funding ready in within 90 days from working with you guys. So they know from day 1 to 30 is going to be the foundation. So you need to pull all their 3 credit reports, identify and dispute any errors, pay down utilization cards, and add authorized users if they are needed. In between day 30 and 60 is going to be optimization. So you're going to be requesting credit line increases on existing cards, apply for new tier 1 credit cards or tier 2 if needed, continue pay down balances, apply for loans if they needed to even lower the utilization in some cases, and then monitor the score for any improvements. And then day 60 to 90 is going to be the final preparation, which is going to achieve the target utilization, ensure all payments are current, prepare the business to make documentation, and plan for the funding application strategies, which I have other video where I show how to do all of. Now let's talk about some red flags that you have to watch out whenever you're doing this. So we have some that will automatically disqualify your clients if they're present, and those are going to be recent bankruptcy, so less than 2 years old, active collections or charge-offs, late payments in the last 12 months, and maxed out credit cards. Then some others that may not be an automatic denial, but they can be some warning sign. Those are going to be too many recent increase, only subprime credit cards, so tier 3 cards, a very thin credit profile, so under 3 individual accounts, high debt to income ratios. And how can you fix these issues? Are going to addressing these issues before even applying, so they are not going to be an issue for funding, and you'll basically be wasting everybody's time, and you're going to also hurt your reputation. So if there's too many increase, remove them. if they have a thin profile or only bad, like tier three credit cards, apply for new credit cards, wait 2 to 3 months, and then do the applications. And for way high debt to income ratio, pay down some of their debt. You can also add get approved for a personal loan to pay everything down, which also can help with the credit mix and the handling different types of debts. So once you know that the client's credit is optimized, you want to check it monthly. Check all three credit reports, monitor their FICO changes, watch for any unauthorized increase, track their overall utilization levels, do some monthly reviews with the client himself, and request credit line increases in the meantime, evaluate any account performances, plan for adding funding for additional funding rounds, adjust strategies as needed, check the annual optimization, close any unnecessary accounts, upgrade subprime credit cards, reassess the credit mix, and then plan for major funding initiatives. Now, let me show you how this can actually work with a real client. So, these are real results that we have achieved with a client. When we first started working with us before the optimization, we were a 650 FICO score, 85% credit utilization, only three credit cards that were also maxed out, and they had recent late payments. After 90 days of working with us, he achieved a 720 credit score, 15% utilization. He had six credit cards with the total limits of collectively of $75,000. Perfect payment history because we removed the late payments, which normally we don't want to work with people with late payments, but it happened. We found out about those late payments after he signed up with us. So it is what it is. We just helped them remove those late payments, and we were lucky that we were able to do it fast enough. So the result was $125,000 of funding approved in multiple business credit cards. The average between all cards was about $15,000 per card, all with 0% offer. Now you can see that structuring your client's personal credit for maximum funding is not optional anymore. It's the foundation where everything else will build on. You can have the perfect business set up, but if the personal credit isn't right, they will get denied or approved for tiny amounts, because the clients who get 100, 200, even $250,000 in funding all have one thing in common: perfectly structured personal credit that follow this exact blueprint. So if you want to learn the complete system for analyzing, optimizing, and structuring your client's credit for maximum funding, join the Funders Academy for $99 a month. We'll teach you the exact tools, processes, and strategies to get consistent high limit approvals. And if you want the complete business infrastructure, including the credit analyzing software, the personal help implementing everything, and the marketing system that will attract this type of client, join our inner circle. The links are in the description, so don't let another month going by where your clients are getting denied when you could be getting approved for six figures in funding amounts. This is Clarissa, and I will see you in the next video.